Hello guys, welcome. So I want to show us something very interesting today, and that is how to determine our daily bias using ICT's IRL to ERL. Now when I say IRL to ERL, it's a very popular concept in ICT, right? I'm very big on direction on Pips Dojo, and I always preach that for you to be able to take a successful trade, you have to have a predetermined direction and you have to look for your entries only after getting a good direction in mind. Okay, now how do we look for direction? There are so many ways by which you can look for your direction, and one of which is this I'm about to show you. This is a very important concept as well. Over then my next videos, just stay tuned and I'll be showing us other ways we can get our direction or our directional bias. Okay, now before we go any further, kindly subscribe to the channel and turn on your notification bells. Thank you so much. Alright, so let's talk about ICT's IRL to ERL. Now IRL to ERL. Now when we talk about IRL, what does IRL means? It simply means the internal range liquidity. Okay, internal range liquidity. I was talking about liquidity in my previous video. Okay, and I was saying it is one of the bedrocks of trading. As a trader, you have to understand liquidity well, right? External range liquidity. Okay, what do we mean by the internal range liquidity? It is simply otherwise known as the fair value gap. The fair value gap, or the SMC people would like to call it the imbalance. Fair value gap. Okay, fair value gap. And then our external range liquidity is highs and lows. Highs and lows. That is what it simply means. Okay, how do you determine your directional bias using these very two concepts? Now this is what ICT says concerning this. It says price often move from the internal range liquidity to the external range liquidity. So price seek out internal range liquidity, which is otherwise known as the fair value gap, and then once it seeks it out, price then from the internal range liquidity has a probability of pushing out into the external range liquidity, that is to go and clear and hold high or and hold low, and after clearing and hold high or and hold low, there is the probability of price to return back into the fair value gap. What do we mean by this? Alright, so let's go into an example. Okay, so I marked out this, and I think there's also another one. So let's see what we're saying. This is a fair value gap right here. I marked this. This is a fair value gap. What did the price do? Price created a fair value gap after an impulse move in the market, leaving behind liquidity, right? This is an inducement at the fair value gap. Okay, what is our expectation? Remember, IRL to ERL, then from the ERL back to the IRL. That means price will go into a fair value gap, then from the fair value gap go to clear and hold high. Okay, what did the price do? Right, price broke this structure. There's a mini structure. If you zoom in, this is, by the way, this is the higher time frame. To get the IRL concept to the ERL, always use your higher time frame narrative. Okay, preferably start from the daily time frame or any other time frame alignment you want to use. Okay, but for this example, I'll be using the daily time frame. So price broke is structured. First thing you need is a range. Okay, that is why it is called the internal range and the external range. Range is included, right? You need a range, and this is a kind of a range here. So price broke that structure, and once it did, it left behind liquidity at the fair value gap it created. Okay, so you're expecting price from here to move back because price is already at ERL. Okay, let's label here an external range liquidity or external range ERL. Okay, price is at an ERL. From an ERL, we expect price to come into the internal range liquidity, which is the ARL. Now, when price came here, how could we have gotten our entry? Now, let's go to a lower time frame, probably 15 minutes. The best time frame we could go to could be the 1 hour, but for clearer and a more simplified stuff, let's go to the 15 minutes. Okay, now on the 15 minutes, I'll show you how you could have caught the move on the 15 minutes. Okay, this is our ERL. Price has gotten here. Yes, as you can see, price has cleared this structure. Some would like to call it an MSS. Okay, let me label or write there in MSS. Can you see? So price has broken that, and on the higher time frame, we know this is an inducement. Okay, because our IRL is inside here. Let me label this my internal range liquidity. Okay, I expect price to enter the internal range liquidity before it pushes to my ERL. This is my ERL, which is in this case my draw on liquidity. All right, let me write it. Draw on liquidity. Draw on liquidity. Okay, now we have this. So someone that doesn't have an higher time frame narrative could take this as this is a market structure shift, and this is the break of structure that powered the market structure shift, right? Someone without an higher time frame narrative, even when he has a direction correct that okay, this is a market structure shift to the upside, and then is looking for he's looking to catch a long move, right? Could have taken here as a break of structure. It's a valid break of structure, and could have looked for a POI here, but we know from the higher time frame that this is what is an inducement, right? It is liquidity. Price should clear it into our POI. All right, so then that means we'll look for the what? For the nearest entry. Okay, we'll look for our nearest entry below the inducement. And how could we look for that? Right, this is a break of structure. Okay, I talked about a strong structure yesterday. Now I will show you example of what I mean. Okay, this is a break of structure. Check my previous video, it is right there. This is a break of structure. It's very small, but it still is a break of structure. This is a break of structure. Now, according to what I explained in my last video, this break of structure, a valid one, then another break of structure here, a valid one, then this break of structure right here, this third break of structure, what did it do before it broke structure? It simply came back, cleared this mini break of structure to make it an inducement. Okay, cleared it right here, making it an inducement, right? Making here a strong low. Okay, making here a strong low. You can literally label this, right? Check out my previous video, making it a strong low. So our range now is from here, right? for this break of structure, our range should be from here. Then let's look at good entries, and remember we have liquidity right here. So our range, you could literally just pick here. Okay, do you get what I'm saying? You could literally just, now let's adjust our, I'm trying to adjust this. I think my network is lagging a little bit. So we could literally have our POI reduced to this extent. Okay, right? Can you understand what I just did? This is a strong structure right here, and this is the inducement. Okay, so anywhere here is where we expect price to fall, and you could have caught this trade easily. That way, you see what price did, cleared the inducement into the strong structure, and that could have given us an easy, let's see what our risk to reward could have been. That could have given us an easy, let's see, an easy 6 to reward, 6 risk to reward. Okay, on GBP USD. How beautiful is that? An easy 6 IRL on GBP USD. Okay, that is how to use the IRL to ERL to get your direction and your lower time frame narrative. So let's check out something else on GBP USD. Let's check it out. Where else could we have used this effectively? Let's see what we have. Okay, there's something so nice here. I think I also see this. So look at this. Okay, where okay, look at this price. This is a range, right? Our higher time frame range. Remember, the first thing, identify your range. Okay, it's a higher time frame range, and on this range, what happened? I'm coming. And on this range, what do we have? We have our IRL. Okay, no, so from the IRL here, price came into the IRL, which is also known as your fair value gap, and then displaced with here as a possible draw on liquidity. All right, so let's go to a lower time frame and see how we could have caught the trade. This could have been your liquidity, right? That for sure price is going to clear. This could have been your liquidity. Let's see. Okay, let's go to the 1 hour and check it out. Okay, very beautiful structure. I like what I'm seeing. So remember, this is our higher time frame range, and right here on the 1 hour, okay, we have a breaker right here. Price didn't reach the breaker before it moved. We have a breaker all the way here. Price didn't reach the breaker. Okay, let's see how we could have caught the trade. There was a mini break of structure. We were expecting that to be our inducement, which price did clear. Then the price started our internal structure. Check out my video on market structure essentials. Okay, I talked about the internal structure and the external structure. All right, so a break of structure to the upside, a market structure shift. Price started trending downwards. Okay, a break of structure. And then what happened? Let's see. How could we have caught this trade? What do we have on our lower on our 1 hour. If there is nothing on the 1 hour that we could have used, I want to use something, something that we could relate with, because I'm already seeing, ways I could have cut this trade. Okay, because from this QM, but I want to use something we could relate with well. That's why from this QM, price came back to react from this QM and then the move. Okay, but on the 15 minutes, let's see what we have on the 15 minutes. Let's see what we have on the 15 minutes, if we could get something interesting. Oh, sorry. If we can get something interesting, whether price will give a market structure shift of some sort before the movement. Okay, this is a break of structure to the downward, and then this is a market structure shift. I like the 15 minutes chart because you see things that higher time frame might not really show. Okay, you could have caught this trade. It's all about being active and watching out for what you want to see. Okay, then this is an order block. As small as it is, it's a valid order block. Why? Because there is an imbalance. Okay, and it is unmitigated. After the market structure shift here, price came into this order block which has an imbalance. Okay, and then from there you see that was a very low. That was a very low of the rally in the IRL. You could have caught this move from here to here, even this way, right? Price cleared the imbalance, then you are waiting for price to play well into the lower time frame, into the IRL, to catch your next big move. Okay, this could have been a good playing it safe and putting your SL right here. This could have been a good let's see how many risk to reward. A good 7.2 or 7 risk to reward for you. Alright, so that's how you can use the IRL and the ERL to get your directional bias. This is one of ICT's most powerful way of determining your directional bias. It works. Okay, all you need to do is to go back and backtest and backtest. Okay, and then you master it and you know how to use it well next time you are trading the live markets. All right, thank you so much. Kindly subscribe to the channel if you have not done so, and click on the notification bell for more interesting videos like this. Peace.